I tick right here, right? Okay, Holly, are you all right? Holly, right?
Yeah, I am. Although I am filled with Thanksgiving delicious food, I am here. All the tryptophan is starting to hit my body, but I know I can make it till 3, right? 3:30.
It's beyond amazing. We had the same thing over here in the West Side office, and you know, come for a second or third round for sure. Whoever want to join us, it's pretty incredible. So, thanks for joining everybody. This is also recorded as well. Last session that was about 2 weeks ago, we were talking about various topics. You can see the screen today. What we're going to do, we're going to go over some business business fundamentals, led by business coach Fritz Pollard out of Long Beach, and Hattie Wright, Long Beach Coastal. Then we're going to have out of the South Bay office, our CPA will talk about some tax benefits and different ways that you need to learn how to benefit from, right? As a realtor, so how you're going to have to file in certain ways and take some tax advantages. Then we're going to have Kevin, he's a zoning specialist. He will talk about the SB9 10. We keep showing the same thing over and over again, but it's important for you guys to be at the forefront of what's happening and let you know, always understand what's coming. Then we're going to have one of our top commercial agents. He's pretty much like a nationwide agent, and one of his syndicators talking about syndications. That's going to be super interesting. And lastly, I'm going to end up with crypto and real estate. I'll talk about blockchain and give you some insight about what crypto is. It's not a matter of the future, it's a matter of already today, already happens. So we need to educate ourselves about what it is, right? So far, so good. Sound like a plan? Awesome, people keep joining us. So Holly. Okay.
I'm here.
Okay,
I'm here.
hold on.
Oh, guess who else is here?
Look at this.
Oh,
No, there you go. Frizz in the house. Hey guys.
fancy meeting you here.
Yeah, what a coincidence.
There you go. There you go.
All right, beautiful. So the stage is yours, guys, for the next 40 minutes or so, I believe. So lead on, right? And then if you need me to share any kind of screen or documents and whatever it is, I'll do my best as we speak. I'm working on it. So go for it.
Thanks, Manny. We've got everything we can screen share, but I know you guys are going to want these materials. Manny and I will figure out how to get that to you guys before. So Manny gave us an introduction, but I'm Hallie Wright, just in case you guys don't know. I'm the team leader here out of Long Beach. And then, of course, I'm joined by my fantabulous, energetic counterpart, Fritz Pollard, of course, who is Maps Coach to the Stars. So Fritz and I were talking a little bit about what business planning is. And although, of course, it is being top of your craft and addressing some of those new things that we might be seeing in the market, a big portion of business planning is really looking back and reflecting on our numbers, on our production, about our confidence in our business, particularly in certain things that we may not always address. Yeah. So Fritz, why don't you start off? I'll go ahead and share my screen. Okay. So take it away from here.
And let me just do a little bit of like context before we get into the plan. You all should have access to what we call the MAPS business plan, which we've been using and got this out late September.
Yes.
Ladies and gentlemen, one thing I want you to write down, we start business planning too late. So let's just always remember that you can reach out to me, reach out to your leadership. The earlier you get your plan together, the more opportunity you have to refine your plan and get it right before you launch. A lot of our MAPS clients, we launched actually 17 days ago on November 1st. December 1st is a great launch time, so we still got time. You just don't want to wait until January 1.
Right, that's too late.
The year's already begun. So let me just set some context here, and then we'll jump into the outlines. So first of all, why do a business plan? To not get too sidetracked on the unconscious mind, but the unconscious mind is like a hard drive. Your business plan is the software for the hard drive. If you have no plan, you show up every day like a rudderless ship attempting to find your way to nowhere.
Right.
The business plan puts some structure in your mind And just the fact you put pen or pencil to paper actually has just a very unique neurologic experience for you. You will start seeking those plans and those goals by just writing them down. There's people that have literally done plans and put them in their drawer, pulled them out at the end of the year and go, oh my God, I can't believe I hit almost everything that I was projecting. If you went to Bold and you wrote that letter and you opened that letter a year later, you'll know what I mean. Okay, so that's what this is all about. So you got to put the software into the hardware and then you just let it run. That's number one. Number two, this is a big debate that we get in coaching. What is going to be my unit and GCI number compared to what I did last year? In Bold, we double it, we double it, we double it. Here's where I want you to use a little restraint. Look at what you did last year. We're going to look at that, Hallie, here in a few minutes. Look at what you did this last year, and then look at reasonably what would be a good improvement that would be within reach, but outside of where you are today. So I want you to ask yourself these 3 questions as you survey the unit and GCI number. Number 1, unit and GCI, you put it on the table, ask yourself this question. For what purpose is this goal important? For what purpose is this goal important? Specifically the GCI. Now, if you're working with me and you're going to get a little bit of that high octane question coming here in a minute, but we set goals all the time. We just throw it on a piece of paper.
Yes.
And there's no plan around it. We don't know what the purpose is. We don't know what the why is. And no wonder we oftentimes fall short. Number 2, whom will be impacted? We're earning a living. We're earning an income. Who will be impacted by that income? Is it you? Is it family? Is it kids? Is it some
nonprofits that you donate to? Yeah, absolutely.
That's a huge aspect. And then why is that important? So really sit down and ask yourself your questions, these 3 questions around the GCI number. It's going to give you more grit and connection to that number than just throwing it on the wall and then throwing the business plan in a desk. Okay, next. I'd like to challenge you to ask the next following 3 questions, maybe 4, when it comes to the goal itself. So again, we had said, why is that important? Why is the goal important? That was covered in the last scenario. The next follow-up to that, though, is how bad do I want it? So here's the setup to that. On the day you're sick, you got punched in the gut, there's been upheaval in your life, there's all kinds of things going on. I want to know the goal that you'll still commit to making that day productive. When everything's going sideways, when you get punched in the gut, I want to know the goal that you're willing to commit to when everything's going sideways. That's a goal that you will fight for. If it's too far out of line and it doesn't have meaning and there's not a why to it, we're going to roll over and go back to bed. And that's what's the challenge when we set goals that are outside of our reach. And then what are you willing to give up to get it? If you fall behind on your goal, you may have to lead gen on a weekend because you've fallen behind. That's giving up what you would have done on that weekend. So what are you willing to give up? So again, why is the goal important? How bad do I want it? What do you do on the days you get punched in the gut? And what are you willing to give up? If you go through and answer those 7 questions, 6 questions if you remove the one, how bad do you want it? Or how important is the goal to you? You're going to set a goal you're more connected to and will own. Okay, any questions on that before we move on to the actual business planning part?
No, I just want to make a statement. We hear all the time the arbitrary number of real estate, right? Oh, I want to make 100,000. I want to make 200,000. It's always those increments, and sometimes exactly the questions that you were asking makes us ask ourselves why. And even that arbitrary number, is that really what you need to fund your life?
Right.
Is that really what you need to make a change in your family's lives, to go on that vacation you guys have been planning for? Make sure you really give some thought into what that is. Of course, we'd love to increase our business 500% every year, right? Yeah. We would love to sit down and go, I want to get double or triple the business. But the reality is, if it's not a smarter goal, which we talk about a lot, the smarter goals, and it's not measurable and it's not specific and it's not attainable, you're going to be dealing with that internal conflict constantly.
Totally.
Of feeling like you're behind, feeling like
Totally.
you're not accomplishing anything. We talked about that a little bit earlier today when we were doing the Capper plaques, and we were saying that it was a great quote from Oprah Winfrey, and I'm going to find it for you guys, but basically saying that when we celebrate those things in our lives, we have more in our life to celebrate, right? So when Fritz is talking about all these goals, make sure you guys feel good and tangible about what that actually is. Now, we don't want to shoot the bar too low.
Right.
We do want to push ourselves, but at the same time, again, make it realistic. In our first year in business, are we going to earn $2 million? That would be awesome. But in reality, no, that's not really going to happen. So just think about those things.
Yeah,
Thanks, Fritz.
it's a great point. And the other thing I'd like to say is when we see really high goal planning and these super high expectations without really a clear plan behind it, there is a motive that drives that, and it starts with an E and it ends with go. And so what happens is our ego is driving a business plan that we may want to, parade around the office, or we may want to share with other top producers. The reality is you're now living into someone else's goal and plan and not your own. And then the minute you fall behind, you want to put this away and never look at it again. A business plan that you aren't willing to look at and fight hard to get to is probably a plan that was inappropriately set.
Right. Thank you. Just wanted to share that.
So that's the context. By the way, leadership asks these questions of our agents. Agents, go to your leadership and say, hey, can I run my business plan by you? Leadership, let's go and ask these questions. Hey, how bad do you want this? Who would be impacted by it? On the days you don't feel like it, what's going to cause you to come in and truly overcome whatever's going on in your life to get this plan executed? And if we as goal setters don't have great answers for that, it's the wrong goal. Okay. All right. So let's take a look at the MAPS business plan. Now, this is going to be a quick overview because it's all fairly self-explanatory. So this is in two parts. Okay, and by the way, this I look at this in my sleep. I dream about this because I've just gone through this September through October with all my clients. So there's two parts. Part one is the recap. Part two is next year's business plan. Now, the first thing you're all going to say to me is, I didn't do a good job tracking my numbers. I hear it all the time, and it is what it is. So here's the deal. Our MCAs could be a big help, but we're going to categorize these at the top into two sections: listing side, buyer side. So you go, I don't know how many appointments I went on. So work backwards. Here's what we do in coaching. I'm not going to have you spend 40 hours going through every appointment you went on in your day planner. But if you knew how many you sold in the market we just came out of, if you took 10, how many likely sold? This would be the participation part. If you took 10 listings, how many likely sold in the market we're coming out of? It's probably going to be 10. Okay, big math here. So the very likelihood, if you sold 10, you probably took 10. Oh, but I took that lot and it didn't sell. Okay, it's 9. So now I know what my listing sold is, and I can work backward and figure out the taken. And then ultimately you say, well, when I go on 10 appointments, how many do I normally take? Well, I usually take 9 out of 10. So now all of a sudden I can figure out my appointments. That's close enough for our work or our need. On the buy side, how many buy sides did I do? Great. How many people do I generally meet with to get a buy side done? You can back into these numbers and then call it a day. Except that, start to institute a system for tracking this better, because this data is invaluable in planning for next year. Go ahead.
Absolutely. That's what I was going to say. If you are that person that doesn't know your numbers, write this down as something as a part of your business plan of what you're going to implement. Find the classes that you need to attend. Talk to your team leaders, talk to your coaches. Make sure you guys have this put into place. Now, I just really quickly want to drop a lot of this data can be found on your multi-year trends that your MCAs or agent services can help you guys find, which will track. It goes even back the last 10 years of your production. So those of you guys that have been in business, particularly with Keller Williams for a long time, All of that is available to you every single month as a value of Keller Williams, that multi-year trends report. So write it down, ask it. You guys have done production before in your previous years at Keller Williams. Most of this data can be found on the multi-year
Totally.
trends.
And you just have to wait a month to get it. And
Right.
yet, for some of you that don't track, this is invaluable to using it today. It would just be probably up through October. Maybe at worst case, September, October, soon to be updated. So that's the big heavy numbers, listing side by side and totals for the year. And then what I'll do is I'll do like an estimate or a pacing to get me through the last couple of months so that those are accurate numbers going into the next year. Okay, let's scroll up a little bit. Okay, so now we're looking at sourcing. Now, again, this is going to be probably more detailed than many of you have ever looked at, but it is so critically important to know where your business is coming from. So all you'll do in the first column there of tracking or number of transactions is you'll just put a little hash mark. Hey, that was a past client. Maybe it was a sphere of influence. It was a farm. It was some of my just listed, just sold prospecting. It came from one of my allied resources, a realtor referral, a past client referral, relocation staff. There's even a few lines down here where you can write in, where you get business. I get business from Zillow. I get business from Dave Ramsey. You'll see that on page 2. So you'll put in the number of transactions. I'm going to jump over to income earned, which is the third column over. So if you did 3 deals and you make about $10,000 per deal, income earned would be 30 grand. But here's where the magic comes. Look at your cost of securing business. Now, some of you go, oh my God, I run everything through my personal account. It's all mixed in with, everything else that I do. Maybe this is a good year to break that out and have a business account. And yet, if you do like client events, we didn't do a lot of those with COVID, but they're coming back. You could say, well, geez, I spent $5,000 on that movie night, or I did a calendar, or I did whatever. Start accounting for the dollars you spend to create the business. If you're doing like Zillow and those types of things, I have people that put their dialer expense in there, what they pay a month in there for Zillow, and then we can start to look at what is giving us the return that Gary wants. Gary would ask us to look at a 4 times return. So as I go through and assess this for all my coaching clients, if we're not at a 4 times return, I ask this question: what needs to change?
And don't forget, sphere.
Yep.
If you take somebody out to dinner, to drinks, to coffee,
yep,
drop them those gifts during the holidays, all of that should be included in your cost of securing business. We forget about those things, I think.
Yep.
Right? We forget about it.
And we quite frankly, when we're not paying attention, let's look at this as the dashboard of our business. When we're not paying attention and we're throwing money at a source that's giving us a 2 times return, we need to stop that. That's a poor investment. Now, I will tell you right now, here's the ones I group: past client center of influence, realtor referrals, past client referrals, and staff referrals. I group all of those in and I call them database. I just finished, again, because we launched November 1, all of my clients' business plans. The highest return was 75 times in the database.
Wow.
So $1 spent gave them $75 back.
Wow.
Most people's database will be your best ROI return. So when we look at that, and then we can get rid of something that's only a 2 times return, all of a sudden my business just took a profitability jump. And there's nothing worse than looking at some of these online lead companies that give you a boatload of leads and low conversion rate. You spend 10 grand and you made 12 grand. You're not going to know that unless you do this exercise. And if you were with me as a client, we'd be canceling that service today. So that's how I use this in my coaching. This is about ROI. It's not about being a real estate agent. It's about running a business. And when you have this done, you're now running a business. Okay.
Real quick question, real quick. So obviously we have seasoned realtors on the call, but there are a lot of newer agents or people who have had low to no production. Fritz, what are your tips when they're trying to fill something like this out to gain more awareness of their numbers and their cost of doing business if they have not done any?
Okay, so if you've done zero business, then you got zero to put in here. We're going to probably jump to part 2 and start building a plan for that. Now, you may have actually spent money though
Yes.
in entering the business and stuff that hasn't paid off. Well, I set up my website. I'm, doing giveaways. I'm doing all the stuff that we're hearing in all this training. Put that in as sources of business or cost of securing business that we need to track going into the next year to make sure you're not following another person's game plan that's not paying off for you.
Mhm.
So wherever you are, it's not about making numbers up. Let's just put in where you are today so we know it's legitimate and will be helpful to us,
Thanks.
even with no business.
Yeah.
Okay, let's look at page, actually it's the second page or the top of page 3. Okay, now I just let out the cat out of the bag when it comes to sourcing business. By the way, on average, the clients that I coach and have coached for the last 20 years, about 75% of our business comes from database on average, and it's the highest ROI return, and we treat our database like stepkids. So the reason you go through that whole sourcing exercise is to like hit you with the blinding flash of the obvious. We have to do a 36 touch 4 times a year. We're touching them by phone. It's such a high turnover. ROI in your pocket. You just have to become aware of this. And when you get to own that, and if you've been to any of my trainings, we talk a lot about client events and communicating monthly. Well, there's no surprise then that the final piece before we get to part 2 is database. So I want to go back and underscore the sourcing exercise because database is well, Gary calls it the data bank.
Yeah, data bank.
It's a data bank. So number of in the contact database. So what's the sheer number? Now I'm going to break that down into 2. You're going to have total records, and then you're going to have completes. So let's look at what a complete is. It's name, address, phone, email. Name, address, phone, email. That is a complete record. And then there's everybody else. Both are important. Gary says we delete nobody from our database unless we just choose not to want to do business with them. And there's always those rare exceptions. But the reality is we want to move as many incompletes to completes as a goal, daily, weekly, and monthly, because the more we have completes, the more we're usually connected to that client. They're showing up at our events and they're engaged with us and so on. So don't look at either of those 2 categories as a bad thing. Look at it as a journey that we're looking to get them as completes. Number of agents in the referral network. Again, you see these people at our big events. So just talking with clients about a family reunion in Florida coming up. You'll see the guy that's the Statue of Liberty, and he's Uncle Sam sitting out in front of the event just collecting cards. Well, they're building their referral network, and you talk to those people, they get a big chunk of their business from referrals coming in. So that's a part of our business too. Allied Resources is part of our database. And then let's go down and look at how many calls did we make? How many touches did we make? There's today 36 touches is the low end of the spectrum. 48, 96, more than that is what we're seeing teams that live off their database. And when you look at that ROI return, you understand why they do it. And then so how many times did we call each of these? Now you're going to look at that and go, there's no way in heck I could even get close. Okay, put a 0 there and next year track it. Don't lose a lot of sleep over what you're not tracking. Make a commitment to begin tracking it. And you can see the emphasis on database. All right, let's stop there with part 1. Questions?
Client events are coming back.
They are.
In full force.
In a big way.
In a big way.
Yeah, and you guys, I don't know how we do this with the rest of the Forward Living group, but we do that class on Thursday. I actually have a 36 touch map.
Yes.
Where you plan each of the processes. I don't know, I'll let the powers to be figure out how we involve the rest of the group in that training. Yeah. If we choose not to love on that database and do those care calls, we are leaving a big chunk of our business behind, or we're at least not getting the most that we could out of it.
And we all did that at the beginning of COVID, right?
Totally.
That's what everyone did. You buckled down, you had nothing better to do but sit in your sweatpants and eat your DoorDash and call people. right? DoorDash, Postmates,
I came
whatever
in
you
every
want.
day.
Yeah, Fritz was in here every day, but that's what we had time to do, right? We were all sitting at home trying to be busy. But I think now is that time. Just by the way, guys, sidebar again, these documents are going to be sent out to you. We've had a couple questions. They are going to get to you. Don't worry. We're going to, all this maps goodness is coming to you, but we all had time to do that. And I cannot stress enough, we have to start engaging with our database again in a very active way, because guess what? If you're not, somebody else is.
Yep.
Somebody else is. Okay.
Yeah, well, let's plan how we get that whole
Yeah.
map thing to the whole group. 'Cause
We
it's
will.
really, really an easy and important step to next year. Okay, let's go to 2022. Hopefully someone's checking the chat
We
there.
are,
And
yep.
can cue me if
We're good.
we've got any questions.
Don't worry about it.
Okay, so now it's almost the mirror image of part one, now set up as a projection for part two. So, you know, if you know what you did this year, we're going to make better estimations for next year. You know, if you increased your business by 20% year over year, you'll double it every 5 years. So if that was a minimum, and then you say, gosh, could I add another source? Could I add another activity and go to 30% or 40%? Now, all of a sudden, you're building a plan on a rock solid foundation, not just throwing ego numbers to go share with your buddy in the cubicle next to you. Okay, so again, listing side by side. I like to work bottom up. So look at your listing close. And here's a question you ask yourself. If I went on 10, what would I take? If I took 10, how many would sell? I'll tell you something. We had a 90% plus sale rate on every listing. We conservatively bumped that down to more like 85%, just in case the shift showed up and knocked us upside the head. So we pulled everything back, but we knew what the number was. So we were pulling back numbers. And if we're wrong, we're probably going to be wrong on the better side and we'll actually do more. So again, this is why you track numbers, is you can go back and make these educated guesses. So you got your buy side, your list side. You could take the language of real estate, that's what LOR stands for, and break this all down. So the total closed units, the volume of total closed, listings taken. I look at that. They're good to know numbers. I don't lose a lot of sleep over them. The real important numbers are the top numbers. But if you wanted to look at that, a lot of people still look at volume today is a super important piece. And I get it. You know, your commission to volume is a real number. But, you know, this is all your multi-year trend numbers.
Mm-hmm.
And so
Yeah.
if you look at this, we're just projecting that for next year. Okay, so this is where it gets fun. Let's go down into the next section. Now what you're doing is you're breaking everything down to a month. Okay, you're breaking everything down to a month. This is where this becomes real. Okay, and I'm going to give you a real life experience because right before coming out here, we were having a slightly come to Jesus conversation with a client that will end at about 153 to 155 units. They just loaded a closing for December 29th, so we're still counting. But after a while, that'll roll into the next year and so on. Their goal for next year is 225. Now, they took 113 listings. This year, that number is going to jump up significantly. It's 17 listing appointments a month and 12 taken. And we started this month. How many do you think they've taken so far? If you were just going to take a guess. We're not using anybody's name, so we're keeping this. Okay. So it's the month of November. They're going to make about 2.1 million GCI. So top line number, she's keeping a good chunk of it. But we just are finishing a great year, a little bit of celebration. It's Thanksgiving. It's November. Market's starting to shift. They need 17.
Less, yeah.
Okay. How much less? And I may have let the cat out of the bag come to Jesus meeting we just had.
I think less than 10, probably.
We're
Less than
probably, we got 3 in the hopper
Yeah.
and they need 12. So what I told them is, and this is why the monthly becomes important, we cannot carry a big number into December because guess what? December, they need to do it again. We did throttle it back a little bit because of the holidays. Spring, we bumped it up a little bit, but not by a lot. When you know what your monthly requirement is, you can now institute a number of different things like the 15th protocol. 15th protocol is if you're behind goal by the 15th of the month, you stop everything and you get you and your team and you get back on track. This is setting real goals. So we're meeting again on Monday, and I said, you better tell your team we may be having all day, every day call sessions except for Thanksgiving, or else we're adjusting your goal and we're 3 weeks in. But this monthly thing is a real deal, and we sit there and we become blind to this, and then we wake up in April and go, I don't think this is going to work.
Yeah.
And in reality, we just started. But if the behavior doesn't change, the goal can't change. So I'm constantly fighting behavioral changes, because of 155 to 225, that's a big jump. But they also have 4 more new people that they didn't have this time last year. But that still doesn't mean that we're hitting on all strides. So please look at this monthly thing as a reality check, saying, wow, that's a big number, but I got all year. Okay, this is what it means now this month. So really lean into these monthly numbers. Any thoughts on that?
Yeah, well, so I've had a coach at one point that used to work on a sliding scale. And that's something that I've done before where, essentially you dial back some of your monthly goals in some of those slower months, the November, the December, but then you do expand and increase some of those when we're in our busy times, May, June, July. I also think that when you look at all those numbers overall, when we have months that we don't hit our goals, we have to remember that essentially we're carrying that loss forward in our business when we go to expenses.
Yeah.
Does that make sense? So when we're not reaching those, we still need to make sure not only do we reach our goal, but preferably exceed it to be able to make up for the rest of the year. We always have that scramble as agents, right? November, December, it's like, oh, we're to the end of the year. We have our families, we're buying gifts, we're going on vacations. If you stack and plan these goals ahead of time, quarter 1, quarter 2, and really focus on getting in tune with these numbers, the pressure isn't there, right?
Yeah.
The way that you set that up just really leads into the next month.
Yeah, it does. And so let me also put this out on the table. I love Jim Rohn. If you ever got to see him years ago, he was a really gift to self-development and motivational speaking. He always used to say, work like summer in winter.
Yes.
And that applies to right now, because if you leave too much behind in November, December, and January, you can't catch up. I mean, it's a miraculous evolution. If you were to catch up, it's tough to catch up. So work like summer and winter. So here's a reality check on the holidays. How long is Thanksgiving?
1 day.
It's 1 day. Now, no disrespect, we're entertaining probably 15 people. Now I'm not. I had to bring to our potluck here, call my wife, and she had to whip something up, and here we go. So it's a little bit different for me. But at the end of the day, how many days is it, even if you're hosting?
Right.
So take that time, a day before, a day after, maybe hire someone to clean up. But we make this thing like it's this whole month deal. And then we go to Christmas or Hanukkah or whatever you celebrate, and it's like, that's a month and a half. I mean, some people think that Halloween is a holiday, and they start picking out their outfits in September. And we've lost the whole end of the year, and it's justified in our own mind. It's 1 day at Thanksgiving. It's probably day before, day after around Christmas. Do your fun things with the family, block it out. But I did with one client today. He's got 10 business days left to go find his gap. So let's get real about the holidays and work like summer and winter. Okay, this part, top of this page, is literally just you taking your top business sources and owning it. So database on almost all my clients is number 1. Farm areas, for the most part, are number 2. And then you get into sign calls, open houses, online lead gen. But you're going to know what your percentage return is and what the percentage of your business from this year. And you're going to now make decisions. And then I always ask, can we 10X anything that's here? In essence, if we got 57% of our business from database, how could we get 75% this next year? And maybe what do we cut off at the bottom that's sucking our time, energy, and money that needs to be off the docket because we didn't get a 4 times return? So this is just kind of a recap, like what do I need to double down on? Okay, let's go down a little bit further, then we'll open up the Q&A. Now, this is a big one, database. Current number complete database records. So we talked about this before, is what is your goal to collect completes? We've had a lot of success during COVID with what we call the reverse fold 100, where you actually have 100 people call you and they register for something. That's a great time to complete your records. They don't get registered unless you complete the records. So you update the records. We've had some great live videos and Facebook Live where like the whole team is in there fielding calls, and every call that comes in, they're updating that record.
And what a great holiday lead gen idea,
Oh, totally.
right? Do something that
Totally.
someone could re-gift. iPad, technology always really works when you're doing the reverse fold. If you guys have more questions about that, reach out.
And then ultimately, I'm going to throw out a challenge for all of you. You all need to double the size of your database. If you've got 1,000, this time next year, make it 2,000. Be so purposeful. Take 48 work weeks and divide that into whatever that number would be, and you'll be shocked at how small it is. But if you don't double your database, I'm going to argue you're building probably your business in the wrong direction. So whatever it is, if you're Laura Gillot, who I got to interview at the last day of family reunion in Dallas, we had 500 people in a room at 7:30 in the morning on the final day. It was a packed house. Most of them were there to see her. She did 400 units out of a database of about 2,500 people. But the larger incomplete database is in probably the 12,000 range. So I'm not asking you to add another 12,000 to make it 24,000. I'm saying take your database and just double it. And if you did that, I'm telling you right now, you'd be running this goal planning session next year. You'll be here with Hallie, and that would be a good thing. Profit share. What's your plan there? It's called mailbox money. Help your team leaders bring people in. Hey, I'm doing great. Why don't you come in and join our office? It's a great environment. Have a profit share goal. Have a net worth goal. Now, I might be introducing what I call our tracking hub that I use with my clients at MAPS. And that actually has a net worth tracker on there. Just a little bit of energy in growing your net worth. You'd be shocked at what your unconscious mind will do when you insert that software into your unconscious mind. Where do you want to be in 1, 3, and 5 years? So here's an interesting call that I was just reviewing before we had a little Thanksgiving thing.
2 minutes. 2 minutes.
Yep,
2 minutes?
got it, Minnie. Thanks.
Is a gal that had hit her goals. The coach asked her to set a 5-year goal, and she wants to give back because she adopted a foster kid. She now wants to create like an adoption network so that she can take what serves and fuels her and share it. So I'm listening to this call, and all of a sudden she starts breaking down. So her goal of achieving her business has now become something about more than just selling homes. And she even said, your mission used to be the business, and now their mission is serving for what the business provides. So set some exciting 1, 3, and 5-year goals. The final piece here is what events are you going to get to? The truncation there is a little bit off, but do you have a plan to go to family reunion, to go to bowl, the mega camp? If not, I'm going to challenge you. What are you doing to grow? Go hang out with people that are doing more than you're doing. We spend too much time with people doing less than we're doing. What's that about?
Comfortability.
It's called E and ends and go. So go hang out with people doing more than you're doing, and it's at these events.
That's great.
So that's all I got. What have you got?
No, that's it. Thank you, guys. So again, Manny is going to send this out. The portion that we didn't get a chance to cover, which Manny will still share, is basically in a business evaluation where you're going to go through each one of those sections and rate yourself on a scale of 1 to 10, yes, no, and your confidence and level of each one of those activities, whether it's marketing, maybe it's managing, maybe it's your escrow process, maybe it's your team building, whatever that is, go through. And as you're building these actual number assessments, go in and look at the activities that you're doing and your confidence in those. Both of these things that we gave you are literally a playbook that you can take to your coach or your team leader. Thank you guys so much. I don't know if it's Louis who's next. Appreciate you guys.
Well, hold on, one more thing. I didn't get the memo. I wore black. Minnie always wears black.
I don't think I've
What's the deal?
I've ever seen Manny in a white shirt.
What
ever.
are you doing?
forever. And of course, he wears it at Thanksgiving. It's so messy. How did you not spill anything on that wine?
I got a gift from our Pacific Escrow Coastline Escrow girls, and it was a cool T-shirt with the Pacific logo, and I had to wear it. And you have to live with it. That's it. Okay. So,
thank you, Fritz.
right.
Thank you,
Hey,
everybody.
quick follow, highly right. Thank you, guys. That was amazing. And now, if you just joined us, okay, I did share in the chat the links, but no worries, because like the first session, I'm going to share the recordings for this session and all the handouts as well. So just wait for the email. Everything's okay. All right. Now we're going to jump to our CPA, Louis Vasquez. Louis, I see your name over here. Can you speak up? Can you talk, or did I put the wrong user? Oh,
can you guys hear me?
Yeah, I hear you. I see you. You're looking sharp. Louis,
All right.
what's going on?
Yeah, I'm over here at the South Bay office in one of your training rooms, and we're gonna go over some fun stuff. I mean, if you can just scroll down a little bit so they can see Aaron's email. Those of the people, those in attendance can see Aaron's email.
Yeah, give me a second. It's gonna.
I'll put it in the chat too.
Yeah, I'm gonna add all the information. Just give it a second. Just the bar over here just stuck. It's okay.
Yeah, I have. If you guys want to email,
Here we go.
if you guys want to email Erin, that email is I put it in the chat. You can email her. She's with me right now. She'll be able to send you guys this handout, because there's gonna be some things in here that's gonna help you guys out on your day-to-day operations as realtors, business owners. So I'm gonna dive through this 20 minutes, just what we can do before the end of the year, 1099 contractors, those of us getting started in real estate, what we can do. So we'll just dive into it. All right. Maybe go to the next page. This page here is just basically, we always give this out, 70 of the most common deductions for realtors. It's a chart of accounts for you. So it's everything that's tax deductible that would potentially, it's for business owners, but you want to go through here and circle anything that would apply to you. So anything on here that you're spending money on in the course of business for your day-to-day operations as a realtor, you want to keep track of those, as Haley was saying before. Keep track of those numbers, because essentially you can deduct these. It's like you get paid to keep track of this, because your tax liability will be less. We go to the next page, Manny. Yeah, and this is just showing you guys kind of an example of someone making $80,000 a year, and how important it is to keep track of expenses. So someone that's lazy on keeping track of expenses, they only deduct $20,000 on the 80. Their taxable income is 60. After everything, they're going to owe about $12,000, compared to someone who's doing well in the middle that's keeping track of it. This is a $10,000 difference between keeping track of your deductions, and it literally yields a difference of $2,500. So it's just an example, just showing you guys, keep track of your expenses, because at the end of the day, you have to report these on tax return, and you're costing yourself by not taking this aspect of your business seriously. Go to the next page. It also, one thing that we get a lot of questions on is, what can we, for your taxes? The first thing is, do I take the standard deduction, or do I take the itemized deduction? So the standard deduction is, everyone gets this. If you have an American Social Security number, you get a $12,400 deduction if you're single, or $24,800 if you're filing jointly. The government just gives this to you. Now, your other option is the itemized deduction route, and that's when you add up your medical costs, the sum of your state income taxes, property taxes, DMV. This maxes out at $10,000. Okay, so there's that aspect of taxes that are deductible. Then your home mortgage interest, that's deductible, and any charitable contributions. So that's essentially how itemized, also known as long form, works. You add those all up: medical costs, taxes paid, mortgage interest, and charitable contributions, and you take whichever is greater, either the standard deduction, that's $12,400 single, $24,800 jointly, or long form. If you add up all your itemized deductions, you go with that. Typically, it revolves around owning a home because of the mortgage interest deduction that you get. Or if you're a big contributor to charity, you may be giving more to charity than that outweighs the standard deduction. So you kind of want to look at it and see which one is more applicable to you. All right, next page. it's Kaiser can answer this. Okay, something that's not very well known is the qualified business income deduction. It's a 20% deduction that you get for being a business owner. So I have an example here of how this 20% deduction, there's nothing you have to do. And typically with deductions, you have to spend money to get the deduction. You know, if I want to get a $5,000 deduction on a business expense, I actually have to spend $5,000. But with this deduction, it's a 20% deduction. You don't have to do anything. It's all about reporting it correctly on your tax return. So this is the section 199A qualified business income deduction. With this deduction, basically, I have a side-by-side comparison here. You can see how it comes into play. You get 20% of whatever net income you have is a deduction for you. So on this example, I have here, this would essentially produce a $12,000 deduction for someone making $80,000, spending 20 on expenses with gross taxable of 60. They get this deduction of $12,000, and in this scenario, it would save them effectively $3,000. So you want to make sure that your accountant is, this came out in 2018. When you're doing your taxes, you want to make sure you're accounting for this qualified business income deduction, because we're going through a situation right now. Well, we had a potential lead, but they didn't really come on as a client, but they missed this deduction and they're looking at a $200,000 tax refund because their accountant did not account for this deduction. So the 20% qualified business income deduction. All right, next slide. Next slide is something that you can utilize, kind of like a cash flow. How much money am I really making on the listing? Okay, just kind of showing you on a $25,000 listing commission, how when it's all said and done, your true take home is usually going to be around $10,000. So first you have your gross commission, okay, then you want to subtract out your expenses, and I have like basic 30-day expenses over the course of a month. And then you have what's called your gross profit, how much money is left over after the expenses for that particular listing. You want to withhold 30% of the number after expenses. So if I make $25,000 on a listing, I don't want to withhold 30% of $25,000 because I'm going to withhold too much. I want to withhold 30% of what's left over after I account for expenses, okay? So in this situation, my 30% withholding is $4,297.50. You have to implement this aspect of withholding for yourself into your business as you're making money, because if you don't, if you're not withholding, setting aside money, you're going to come and do your taxes. And when it comes time to do your taxes, they're going to tell you how much you owe. And if you don't have any money that's withheld to pay it, now you're going to go into debt with the government. So, when you're an employee, all that withholding is done for you through payroll. Your employer does that. Payroll withholds. You have your gross check, and then after all those deductions, I get a net check. So it's happening for you when you're an employee. Business owners, you get that full check, and it's a big chunk of change, okay? You need to be withholding after expenses, because if you don't, I cannot emphasize this enough. 80% of realtors in Southern California, 80% of realtors owe the government at least $1,000 in back taxes. That's the Southern California area. South is San Diego County, north is Ventura County, and inland as San Bernardino County, okay? That triangle, 80% of realtors owe the government at least $1,000. 40% of business owners owe the government at least $1,000 in back taxes as well. And it typically revolves around the failure to withhold. So this is a good little example for you. On the next page, I have if you reach out to Aaron, it's blank, so you can kind of use it yourself. So that way you have that as you're going, pretty much month to month on or listing the listing. So let's jump to the next page, page 7, or page 8, Manny. So there's the blank page, page 8. So there's a couple strategies that you might want to look into as we close out the year if you're making some money. First one is paying your kids. Okay, if you're making money, use your kid's social security number. The kid needs to be about 7 or 8 years old. You actually have to, if it gets contested, you actually have to prove that your kid is helping you. It's really hard to say. I have a 2-year-old daughter. It's hard for me to want to use her social security number and pay her, and get a tax benefit with her being 2 years old. The government's gonna probably say there's no way she's helping you. But someone around 7, 8 years old, that they're probably helping you, picking up your signs, putting out your signs, doing maybe an Excel spreadsheet for you, Google mapping for you. Pay them for that. Show that you're paying that. You can use their social security number and transition $12,000 or less essentially tax-free. I have an example here that you guys can look at, okay? And then below that, something that's newer is vehicle purchases. So if you purchase a vehicle, before it only applied to new vehicles, it now applies to used vehicles as well. If you buy a new or used vehicle from a dealership, it has to be a dealership. It can't be from a private party, okay? And that vehicle is over 6,000 pounds, all right? So it's usually a heavier vehicle. So like a truck, a bigger a full-size SUV, okay? If you buy the vehicle and it's over 6,000 pounds, you can write off 100% of the purchase price of that vehicle. So if I'm someone where, you know, I have profit of $100,000, okay, and I'm looking on a strategy to minimize my tax liability, I would say, hey, you know, what kind of vehicle are you driving? Or is it time to replace that? Look into a heavier vehicle. So if I'm making $100,000 a year and I go out and buy a vehicle that's $65,000, let's say, I can take that full $65,000 deduction. So now instead of getting taxed on 100 grand, I'm only going to get taxed on the difference, which is about 30 grand or so, $25,000. So it has to be a vehicle over 6,000 pounds in order to do that. And it can get financed. So we don't care about if you paid it all up front or if you financed, okay, it doesn't matter. We're just looking at the purchase price. What was the purchase price of the vehicle that you purchased? And then if you finance it, we can also write off the interest as well. So something that is a little bit newer, where it applies to both new, this used to only apply to new vehicles. This now applies to new and used vehicles. So some little tips there, paying your kind of year-end strategies as we're going to the end of the year. What can you do to mitigate your liability, minimize it? Maybe get your kids, pay your kids for some services that maybe they're helping you out with. And then also potentially looking at a vehicle purchase if that's a route that you want to go down. So let's go to the next page, and we're 5 minutes left, and then we're pretty much done here. The next page is just kind of showing you guys the almighty S corporation. I love the S corporation. It's one of the greatest things ever. The small business corporation, basically a side-by-side comparison. Someone with an LLC, no entity, sole proprietor, someone with an S corporation entity, and someone with a C corporation entity. Side-by-side comparison, someone making $100,000, showing you the different tax liabilities through each entity. You'll notice in the middle, the S corporation will have the highest take-home pay and the least amount of taxes. So that's something that you guys will want to look at. The next page is just another example showing you the impacts of an S corporation for someone making, you know, $125,000. You can see line 22. Okay, this is getting you guys ready as we're going into, everyone here should be a six-figure earner. There's no reason that you're not a six-figure earner. That should be your mindset. That should be the goal. We should all be six-figure earners here. Okay, so here's a six-figure earner, $125,000, six-figure, seven-figure, eight-figure. That should be the mindset. I really enjoyed Haley and her partner, what they were talking about. It's all about the mindset. Okay, so let's prepare for that. If I'm making $125,000 without a legal entity, without an S corporation, you can see line 22 at the bottom. I'm going to owe $32,000, $31,950. So that's preparing you guys. That 30% I said you need to withhold. Time and time again, we get business owners, contractors that are making money. They get the whole check and they spend the whole check, and come time for tax season, we're telling them they owe $30,000, $40,000 in taxes, and they say they only have like $5 grand, and so now they're in debt. They owe the government, you know, $30,000, $40,000. We see it time and time again. Next page is just showing you how an S corporation, if it comes into the picture with an S corporation, line 22 stays the same. Line 22 with an S corporation is still 125. We're paying ourselves strategically with the entity, but you can see that line 22, the amount of tax owed is practically cut in half to $17,000. So when you'll want to start looking at this, when you're starting to make about, I would say $75,000, that's when you want to start looking into a firm that's advising you and potentially setting this up for you. Because as you can see, there's a substantial amount of money that would be potentially saved. There's a decent amount of fees. It costs about $5,000 a year, so that's a good rough estimate. It costs about $5 grand a year, $3,500 to $5 grand a year is what it costs to actually maintain that legal entity. So once you're making about $75,000 a year, you want to start meeting with an accountant, because essentially we're saving you money to the degree that it's almost like additional income just by structuring yourself properly. And that's pretty much it as far as everything in 20 minutes, guys. You know, happy to answer any questions if there is any. And then Again, Manny has the attachment of what we just went over. This is very helpful for you guys. And then reach out to us if you guys want this sent to you as well, okay?
Good stuff, Louis. Yeah, a few questions over here. I'll do this. Oh, there he is. Yes, questions.
So if you already have an S corp for a different business, can you change it to real estate or apply for a new one?
Yeah, technically, you're supposed to have an S corporation for each business activity. So let's say I have a business that's real estate and I have another business that's e-commerce. Technically, you need to have 2 S corporations for each business activity. But what I would do is just to minimize the amount of work and the amount of fees is have 1 S corporation, change the name to something generic, change the name to, you know, your last name Enterprises or your last name and associate, something generic. Okay. If it's very specific, like if your S corporation is, you know, Team Realty, then that's very specific to real estate. But just have a very generic name and then just put all of your income as a business owner through that 1 entity. That's what I would do.
Yeah. Did I answer the question?
Thank you.
Okay, cool. Question on the chat, Louis, from Elizabeth. If you don't have kids, can you pay someone else's kids with the parents' consent and write off that on your taxes? I love that question, Elizabeth.
It's a great question. You know, it's no different than if, you know, these kids that are working for bigger companies, you know, McDonald's, they don't need no parents' consent, you know? So yeah, you know, if you have another kid that's necessarily your child, and you can actually pay them and transition some of your income to their social security number and they're providing services for you, why not? Why not? That's a great idea, actually. They say that, you know, the best ideas do not come from us accountants. The best ideas do not come from us accountants. The best ideas come from the clients. Hey, can I do this? And then we say yes or no. And a lot of times you guys have better ideas than we do.
Yeah. Another question was, would consulting work for the 1 entity idea?
Yeah. If you're getting paid as a contractor for some consulting work, yeah, why not put it? There's no reason that you can't put it through an entity.
Question?
Hi, this might be similar to the previous question regarding 1099. I'm just getting started.
Good.
So all the deductions, then for all the expenses I'm incurring this year, I'm okay to write those off for next year, right?
Yeah, typically for someone first year in business, regardless of industry, typically someone first year in business is losing money is typically what it's like. The amount of money you're spending in relation to the income coming in, the expenses outweigh the income. So I'm losing money. You definitely want to report those expenses, because if you have other income, let's say I'm starting a business in a year and I lose $10,000, but I have another job and that job I'm making $50,000 a year, those 2 offset. So if I'm making $50,000 a year from another job, losing money from a business venture of 10,000, I would only get taxed on the difference. I only get taxed on 40 instead of the 50.
And does that 199A?
That only applies when there's profit.
Okay.
There needs to be profit in order for that deduction to be applied.
Okay, and then let's say, hopefully I make more than 50,000 next year, so I can't do the S corp, and that's the plan. But let's say until then, can a DBA instead of LLC?
Yeah.
Okay.
You typically want to look at those entities around 75 is when I would start looking at it. Before then, you're fine offering DBA or operating under your social security number. No, either would be fine.
Oh, okay. All right.
Question.
Yes.
So
Yes.
199A, I'm sorry, I jumped.
Go ahead.
It is only if you do the long form, correct?
No, so that applies to business owners who are making profit, regardless of long form or short form, standard or itemized. That is for any business owner that is profiting, regardless of how you're taking standard deduction or itemized deduction.
So you still can do it with either one form.
Either one. If you guys wanted to look at if you guys made money last year and you wanted to look at your tax returns, okay, if you made money and you want to look at your tax return, you want to look at, let me look real quick. Individuals, and put my tax return real fast. I'll tell you what line you want to look at just to make sure your accountant actually accounted for it. You want to look at you guys all want to look at on your 2020 tax return, you guys all want to look at line 13. What is line 13 is that qualified business income 199A deduction, line 13. If I had a profit last year, is there a number on line 13? Like I said, we had someone inquire about 4 or 5 weeks ago. They did not do that correctly, and they now have, the government now owes them $200,000.
Oh, so it means that I can amend my taxes from last
Yes, yeah.
year. Okay, thank you.
We've seen that deduction either get missed or not calculated correctly. We see that often.
Yes.
I have a question. So if you have a business, like an S corp or LLC, can you rent, let's say, basically rent your place to your LLC?
You can do that. It's called the Augusta rule. You want to look that up, Augusta rule.
And then this way you can deduct your rent or your mortgage.
You can deduct the rent, the whatever rent expense that you pay, and then it's also, so that money would be deducted, and the money that you're paying yourself for the quote unquote rent will be tax free to yourself. The Augusta rule. You guys want to look at the Augusta rule.
Yeah. Augusta. Other questions? Anybody?
Fun stuff. So be sure to reach out to Aaron. Many thanks a lot as always, and there we are, right on time.
Yeah, thank you, Louis, as always, and I'm going to share the handout with you guys as well later on. So thanks, everybody. Louis, good job as always. Much
Thank
appreciated. Yeah, good stuff.
Yes, I'm so glad I stayed.
Let me see for a second. I know that Kevin is supposed to jump on the call. Just double check for a second. He was just texting me. Kevin. Hold on for a second, guys. Kevin is up next once again. He's a zoning specialist. He will talk about the Prop 9, 10, those changes that already took, were voted to went into effect effective January, and the differences between the two propositions. And once again, whatever he knows still about that, we periodically sharing hold on for a second. Sorry, guys. Making sure he's getting my right thing. So periodically we're going to bring him to team meetings between now and the end of the year. Next year, just we're going to get more of the insight of what the difference is, because it's once again just new to everybody, right? And it's a thing that change on a daily, weekly basis. So here he is. Let me do this. Kevin. There he is. Kevin, good to have you. Thanks for joining us. Kevin Cohen, who's a zoning specialist. Kevin, can you?
Yes. Hi, everyone. Thank you.
Oh, there he is. Perfect. Yeah. All right. Good timing, Kevin. Thanks for joining again, as always. We had Kevin multiple times in some of our other sessions, right? And we're gonna kind of keep bugging him once in a while to come on by and share some insight. But because this is at that scale, that capacity meeting, we didn't have him, so I asked again, and he was generous enough with his time to go over his few minutes slide and Prop 9 and 10. Kevin, all yours.
Thank you. Yes, I'm here today just to briefly go over Senate Bill 9 and 10. No new updates in such as new cities releasing their code that will comply with SB 9 and 10. We'll have to wait till after January 1st to 2022 to hear that latest ordinance being adopted by each local jurisdiction. But I'll be presenting today just a brief overview and take any questions as necessary. So is everyone able to see my screen here? I assume
Yes.
so. Okay,
Yeah.
great. So again, my name is Kevin Cohan. I'm with Elevated Entitlements. We specialize in land use entitlement and permit expediting services. That's just a little bit about us. We are a local urban planning firm. We are highly experienced with city planning, zoning, land use entitlement areas for single family, multifamily, commercial development. We do solar development as well. We have deep experience at both government, private, and local agencies. We also work with agencies such as Army Corps of Engineers, California Department of Fish and Wildlife, Regional Water Quality Control Board, and U.S. Fish and Wildlife Services. So as you heard earlier, Governor Newsom signed a historic legislation to boost California's housing supply and to fight our housing crisis in California through Senate Bill 8, 9, and 10. Senate Bill 8 is an extension of the previous Housing Crisis Act of 2019. SB 9 is a new legislation, and it provides additional tools to add new housing with California's shortage. And SB 10 is a voluntary action which streamlines the city's zoning process for multifamily near transit-oriented areas. This is a 1.75 billion support for affordable housing in California. And I'll walk you through the SB 9 and 10 information in today's presentation. So what is Senate Bill 9? Senate Bill 9 is a new legislation that is a state mandate. So every city will have to adhere to this mandate. And what it allows is a split of a single family lot. So in this picture depiction, the blue roof of this single family home is now granted a lot split by right. And it allows opportunity for the homeowner to build a duplex on each half of the lot. So you saw from the previous illustrative, this blue roof line home, single family home, has now allowed for a lot split and a duplex on each lot. And this is a by right process, meaning does not need to go to planning commission, no city council, no neighborhood HOA. This is a by right state mandate. So now you've seen it's one single family home. The blue covered roof has been changed into 4 units. So one single unit has been changed to 4 units. So what are the key takeaways of SB 9? So as I stated before, SB 9 applies to all counties and cities. It's a state mandate. It makes it a ministerial action, meaning there's no city council or public hearing required. And it includes a parcel map that splits the parcel into 2 separate lots. With 2 residential units on each lot. Now, how does this apply to what zoning and to what area? So the lot must be a single family residential zone. So for example, in City of Los Angeles, it must be an R1 designation. The parcel must be in an urbanized area or urban cluster. So it cannot be surrounded by agricultural. It must be in an urban neighborhood area. The split results in 2 parcels and they must be equal lot area. And the minimum lot size is at least 1,200 square feet in size. Now, these are some caveats. The project cannot demolish more than 25% of the existing exterior structural wall. The proposed project or property split does not result in the demolition or alteration of, number 1, an affordable rent controlled housing. So if it's a single family lot that is currently rent controlled, we cannot remove or demolish that rent controlled unit. Number 2, the market rate housing has been occupied by a tenant in the past 3 years. Number 3, the property is listed as an historical landmark or is located in a historical district. So if you have a historical home that is deemed historical by the city, it cannot be demolished. And any unit created as a result would not be used for short-term rental. So it must be rented for a term longer than 30 days. So Airbnb cannot be used as a short-term rental during this duplex creation. And lastly, the property owner must have a signed affidavit stating that they occupy one of the housing units as a primary residence for at least 3 years after splitting the property or addition of units. So if you were to purchase this property and develop 4 units, you'll have to live in one of the units for at least 3 years. Now, SB10. SB10 is not a state mandate. This is a voluntary action. So SB10, a city can choose to enact this within their city or choose not to. And what this allows for is a rezoning of a property without environmental review. So usually you have a property that is single family, you want to build multifamily, you have to go through something called a zone change, and you have to go through something through environmental review through the California Environmental Quality Act, or CEQA. What SB 10 is saying is, if you have a single family lot near a transit center, will allow you to do a zone change without any public review review and no CEQA review, and will allow you to go up to 10 units on that single family parcel. Now, these are some key takeaways. Again, it's a voluntary process for local governments, and it will allow up to 10 units per parcel. And again, this simplifies the CEQA requirements and does not have to go through an extensive environmental review process. And overall, from review of SB 10 is definitely more attractive. And a lot of cities have already implemented something similar to this, such as City of Los Angeles with their transit-oriented community, or TOC program. And SB 10 is a voluntary action, whereas SB 9 is a state mandate. So those were some key takeaways. I'm here and open to any questions you may have. Thank you.
Kevin Cohen, always good stuff. To the point. Questions? Yes, you're the front.
Regarding zoning, what if you have two properties like on a corner lot that are like adjacent to each other? But one of the properties is like basically they're in different zones. What happens when you combine the lots? Like,
good question. Good question. So if you're looking to combine two single family lots, I'm sorry, say that again.
For multifamily lots, but one is like, I think, RD 1.5 and one is R3.
Okay, and are you looking to apply SB 9 or SB 10 on either of those lots? Or just a general question?
It's a general question because I was told you could build up to like 17 units, but just in general, like what happens when two zones merge? Like,
yeah, no, that's a great question. So in your example, RD1 or RD3 zoning, or if it has two parcels with two different zoning, when you request a zone change to bring both parcels to one parcel or one project, you can request a zone change to that higher density zone. So in this case, if it's an R3 zoning that is higher than an RD1 or R1, and you can request a zone change to the higher designation. Now, ultimately, it's a discretionary action, meaning the city can approve or deny your zone change. So it's not a by right action. However, if you were to go through SB 10, you can do as a rezone without any environmental review and without any discretionary review, meaning it's by right. So depending on where your project's located and if the city's accepted SB 10, the Senate Bill 10 would be a good tool for you to get that zone change.
Thank you.
Yeah, good stuff. Who else? Questions? Anybody? Let me look at the chat for a second. On the chat, from Chris, I may have missed, but is the state offering any specific financial incentives for cities to participate? Good question.
Good question. Not that I'm aware of. There's no incentives. A lot of cities have pushed back on SB 9. SB 10 is a voluntary action, so there's no incentives being placed to these cities.
Okay. Other questions? Anybody? Kevin, when do you assess that we're gonna have kind of more substantial information about the kind of next step or evolution of this problem?
So what I hope to do is come back to you after the new year and kind of provide a list of cities that have adopted SB 10. So your team is aware that these cities have adopted it. You know, be aware that there's upzoning to these properties in these cities, and also give you an idea how SB9 is going to be implemented in cities throughout Southern California. So I hope to come back to you all after the new year and do some research on which cities have adopted SB10 so you can let your clients know and make informed decisions.
Yeah, because it can be both for the general population and investors, naturally.
Definitely.
Okay, and lastly, do I have those slides, Kevin, by any chance? Did you send them to me in the past? I believe so, right? For the commercial meeting?
Yes, you have it. I can send it again to your team if you like.
Okay, just yeah, shoot me an email. I'm going to share it later on with the recordings of this entire session today and the link to this presentation. Okay.
Beautiful. Okay.
Yeah. Thank you for asking, guys. Kevin Cohen, as always, thank you, and we'll touch base after the first of the year.
Great. Thank you all. Take care.
You got it. Thank you so much again. That was Kevin Cohen, and then let me see. We a couple of minutes ahead of time. Our next chat is going to be about real estate syndications. We're going to hear from both Michael Couchette. He's a big commercial, nationwide commercial agent, specialized in the apartment building niche, and he's going to have a guest named Danny Barnes. That Danny is a syndicator. So they're just going to give us some, one-on-one on syndication, what it is, what it means, how can you as an investor can access that data or opportunities, and how you can leverage that knowledge to gain more either investors or once again increase your kind of sphere and opportunities, right? Because remember, most of the agents today on the call are residential, but everybody who owns a house also might own a business or work for a business. So it's not one-dimensional, it's multidimensional. So there's always opportunities, and you have to know. Naturally, if you have some kind of, not just for yourself as an investor, but any kind of opportunity for you as an agent, and what you can do is always refer that opportunity to a specialist like Michael, etc. Depends on the office and the niche. So let me. Here's Michael, and let's me see if I can find Danny. Give Michael a second over here to log in. And here's Danny. There we go. Let's give him a second over here. Here's Michael, and here's Danny. Okay. Michael.
Can you hear me?
Yes, Michael Couchette. I hear you and I see half of your head. Okay, it's getting better. You can see the eyes?
You gotta love technology these days.
I know, yeah. All right, well, we have both Michael and Danny. So quick intro. Guys, first of all, thank you for making some time to jump on the call. Where this session, as I mentioned earlier, is about just kind of quick one-on-one about syndications, right? Michael Couchette is a big player in the arena, in the apartment building, investment syndications nationwide, based here out of our KW Calabasas office, KW Commercial. And Michael, introduce Danny over there, so we know a bit more about him. And there. Hey, Danny.
How you guys doing?
Danny.
Sorry, I'm in my car in between meetings, and so I'm trying to figure out how to do this appropriately, but it is what it is.
It's all good, man. You busy as shit. Thank you for making the time.
No problem at all.
Michael, if you can introduce Danny, and let's keep it G-rated over here. There's some kids in the crowd, so.
Danny is a longtime friend of mine and one of my very good clients. I think he still owns probably and controls a couple $100 million of real estate across Los Angeles at the moment. And he has been affiliated with some major groups out of New York and Los Angeles, coast to coast. And I can't think of a better professional when it comes to understanding the ABCs of syndication and how that works. And Danny, did I hit that right?
Yeah, I think you I will definitely take an intro from you any day of the week. So I appreciate that, Michael. No, yeah, so as Michael mentioned, I buy and sell apartment buildings mainly, apartment buildings and office buildings throughout Southern California. Been doing it for, I guess now 11 years. We'll be starting this next year. And yeah, we probably bought and sold as a principal over $1 billion in real estate. But yeah, so today control about $150 million worth of real estate here in Los Angeles.
There we go. Titan. I love it.
On the way.
So for a lot of the people that are watching and listening, they are curious on how does syndication work? What is syndication? And I as far as I know, the best way to explain it is kind of crowdfunding money together to put your down payment down. And once you have your down payment in place, then you would get your financing and purchase a property. Does that sound about?
Yeah, I think at a high level, that definitely makes sense, right? So I look at syndication, as Michael mentioned. So say you're looking at a property for $100, you're probably going to get $70 from a local bank, a debt fund, some kind of financing vehicle that's out in the market. And then out of the $30 that's remaining, those dollars are taken between outside investors and also people that are actually the sponsor, the person that's actually doing the work, who found the property, who's picking out the tile and the flooring and all that kind of stuff. And so inside of that $30, it usually works out to about $27 is raised from outside investors. So a lot of times that could be, depending on the size of the transaction, it's a high net worth individual, it's mom and dad, it's friends and family, that kind of stuff. Or it could be, depending on how large the deal ends up being, it's a large institution, so a Goldman Sachs or a hedge fund or a private equity fund of that nature. And then the last $3 is put in by what's called the sponsor, the general partner in that transaction, which would be someone like myself.
So just to clarify and rewind a little bit, you have 3 different levels, I would say, of that 30%, which is your
Right.
sponsor, your general partnership, and your limited partnership.
Right.
And the sponsor would be yourself, for example, where you would put up the $3 out of 100, and the remaining, I'd say, what is that, like 10%? That's like general partners.
Right. Yeah. So usually it's a 90-10 structure. So 90% comes from the limited partner investors, and then you have 10% that would come from the general partner investors. And then inside of that can be structured in multiple different ways. There could be a preferred return, like you would have almost like a bond yield could go to the limited partner, and then also a split of profits in the future. Then the general partner ends up having kind of the opposite effect. So they'll be paying out the bond yield in order to have a larger percentage of the profits in the future. And they'll also be charging fees, so an asset management fee or an acquisitions fee along the way, construction management, et cetera. So there's a couple of different ways you would structure that, and we can get very deep in the weeds into a 400 level class on structuring if we like. But if we want to keep it at a high level, that's pretty much how the deal works.
And so your sponsor basically is the person that's in charge of managing the asset and managing all the investors involved. So they'd be in charge of dealing with the bank, they'd be in charge of dealing with your major investors who cut that heavy check. And then you have that sponsor that would also be in charge of the majority of limited partners. So that could be made up, for example, of 10 people that make up that 90% of the LP. That sponsor also is responsible for managing the asset, making sure the bills are paid, making sure everything is run appropriately, and returns are either distributed on a monthly or quarterly basis.
Exactly. So, I mean, it can come down to monthly, it can be quarterly, it could be annually, it could be only at a time of a liquidity event. So that'd be a refinance or a sale of the property as well.
Okay, and this can go for any kind of, goes for any kind of vertical. So hospitality, single family homes, multifamily,
Correct.
office buildings, retail, land. So I know a lot of people that are watching kind of are asking themselves, like, I want to be that person to buy a lot of real estate one day. And I think what they don't realize is that the majority of deals that are purchased, probably, was that like 95% of the industry runs on syndication.
Right. It's very true. I mean, you'll see the big splashy headlines of the things that are on the Real Deal or that make the LA Times or the New York Times or the Wall Street Journal of these, multi-billion-dollar transactions. And those are a very small piece of the actual market itself. Most of the market is in much smaller deals, depending on, where you are in the United States. If you're in Los Angeles, you're buying a fourplex or a six-unit building or an eight-unit apartment building. And that's usually with people passing the hat, as we call it, and filling out the investment that's available to actually closing the transaction, and then have enough money for said renovations, releasing the property up, and then having some working capital along the way.
That's it. You brought up a good point, actually. You also have to have your working capital as well. So that's like your rehab and stuff like that as well. So you're going to have to raise that money in the syndication as well.
Correct. Yeah. Usually it's a proportion of the entire kind of capital stack itself. So say you're going to go, I used the $100 example earlier. The $100 might be 90 of it might be actually purchasing the property. And then $10 would be the remaining needed for, the upgrades to the units or to paint the building, do some new landscaping, et cetera. And so that you're usually, when it go to the financing market, to go out to a bank or a lender, they would actually be providing me the 70% required against the entire cost. So they call it a loan to cost, an LTC, you might hear it, versus a loan to value, which would be an LTV. And so often, you'd have that loan to cost situation there.
That's a very, very good point. And then also, if I'm not mistaken, you also have to impress these investors.
Usually, yeah. I mean, it's hard to do. I mean, you have to have a track record a little bit, or you have to find somebody, at least initially, that can believe in the vision and show what you can and cannot do within the market. Figure out a differentiator for yourself, that makes you the best in class at something individually. And then from there, it's hopefully having some success in the first couple of deals that you can then use as your track record moving forward. For instance, I started doing this as an actual principal because I've worked on the principal side of the business. That's people buying and selling real estate. I've been doing that for about 11 years, but as a principal, putting my own money into transactions for about 6 years, and I've bought and sold about 27 buildings so far. Not all of them have been rip-roaring successes. Some of them, come out and you're pretty flat, but you get your money back. But the main thing I think with a lot of investors is they want to make sure, one, they get their money back. True, you're going to treat them with respect and honesty, and hopefully, get them a return at the end of the day as well.
So what does that usually entail when it comes to convincing somebody to put in money with you on like any deal, for example? What do you usually have to put together? What's your hurdles usually? What's the story around, convincing somebody to give you the dollar to go in for the 100?
Right. I mean, like, it definitely is a story, right? And so it's asset based. So you're going to find, the right property in the right corner with the right metrics and say, hey, I'm buying this as an off market opportunity. I'm the only person that's seeing this. This is how I'm going to create value, be it via through a construction program, or I'm going to re-demise some spaces, figure out a way to make that work. And then you're also kind of impressing them upon the different pieces that make you better at that than somebody else. And so you can either point to past history and say, we've been able to, I say I do mostly apartments. So I say we've beaten our pro forma, which is our projected rents, on a 15% basis over the last 5 deals. And so even though I'm showing you X numbers, I'm showing you $1,000, I probably think this will be in the 1150 range after the fact, but I'm not going to sell that to you. I want to try to, under deliver, under promise and over deliver, right? You always want to make sure you're in that position. And so it's really said, it's a sales process within that. It's mostly said asset based, and it's also people related. But so as long as you can look somebody in the eye and you can show them the truth and honesty on the project itself, and then structure it in a way that's fair and equitable for both sides, I think that's also a really important thing. So so you can get really into the creative side of the business, which I think I love about real estate, is that a lot of it is analytical, but it's also very much a people business at the end of the day. So you can get really much into the personalities, the experiences on that side, And hopefully, your artistic flair can go out when you paint a weird accent color on a wall, or you can have some tile selections, etc. So there's different ways to be able to have a lot of fun with this business.
So if I can bring you back in a time machine from 6 years ago, what was that first deal like that you syndicated?
Wow. Okay. So the first deal that I did at that time was a little park. We bought that building. It was me and a partner at the time for $150,000 a door. So, less than $1 million, right? So we're going in and we're trying to make this thing happen. And we went through and we did a relocation strategy. We bought out the tenants. I sat down with them personally and we cut checks across kitchen tables once I understood what their situation was. And then, we renovated the building and we ended up selling it for a little over $1 million about 2 years later. After we did a full renovation where we put in washers and dryers, we reframed some spaces, added a bedroom. And so we were able to create a lot of value there in about 2 year time. But yeah, that was the first one. And for the last deal I closed was about a $50 million deal. So it's a very different, kind of ramp up from, $600,000 to $50 million.
So you made quite a jump there.
Took some time, but yeah, for sure. It's fun.
The first one cost you about 600 grand. And do you remember how much you had to raise from that? So is that like,
yeah, I think we spent about $25,000 a unit back then. That same renovation cost today would cost me about $50,000 a unit. Construction costs have gone up dramatically in the last few years. It's almost a 20% increase year over year over the last 5 years. It's been wild to see. But also rents have jumped up too. Rents have not jumped up 100%, but yeah, it was. So I said back in the day, we probably raised a total of 750, including our debt financing and our equity. Yeah, and that was the kind of the total deal. And so we sold it for, I think it was like 1.22 back in the day.
So you made about 500,000, and then
yep.
Out of that 750, how much did you have to put down as a sponsor and the GP and LP, that total amount that you had to raise on the syndication?
Let's see, I think that we had about a $500,000 loan on that project. We took hard money financing on that. We didn't have the balance sheet or the wherewithal to be able to go to like a standard bank and get a 3% loan like you get in the market today to get a 7% loan on that property. So we went to basically a small hard money lender to make that work. And then, so we had the $250,000 that's remaining. We put in $25,000 for our own money and then raised the balance from other investors.
Okay.
So 225 we raised from other investors.
So you, in total, you had to put down 25,000 out of your pocket, and then you had to raise and convince. How many people do you have to convince for that 225?
I think that was 15 people for the 225. So you can imagine in terms of like a capital call event or some other issue that would have happened, it's a lot of people to go ahead and go back to. The most I've ever raised from a group of individuals for a loan, for an equity amount, I raised, this is again about 4 years ago, I raised $2.7 million from 37 investors. And that was just, it's a long process, and you're having a lot of conversations, but that's what you have to do to kind of scrape and claw in order to create a little bit of a track record for yourself.
So you had to go, and out of those 15 people that said yes, how many people was in total out of that? Like, was that 30 people or?
We went to about 40 people. So yeah, I mean, it wasn't a big check, so it was helpful. But yeah, it was still quite a few, I mean, a lot of coffee. you're zooming after a lot of those different meetings, and you're running around the city and going wherever you can to try to make that work. And even you go back and look at it, I don't know if I've ever had a more gratifying raise, right, than that very first one.
That first one had to have been just the biggest pat in the back in the world.
For sure. It's funny, like looking back on it now, it's like you don't even look at deals that size anymore, right? And it's so funny, like how that changes your life. Just that one, the first deal to get it off the ground. And because I think, like I tell everybody that's getting into this business, is just takes time. You just got to go through the process, and you got to start somewhere, and it's going to take your licks, because it can be very academic initially, but once you're actually in the process and you're picking out a tile, maybe that didn't work, or you're trying to do another crazy idea that could or could not be successful, you just got to get in the middle of it. And what's the old saying that's in Silicon Valley, and it starts a little bit crass, but it's move fast and break shit. You
Yeah.
kind of have to go get in there. You got to move around. You got to find some stuff that they can go ahead and create a little bit of a track record for yourself.
Those first 40 people, how was that experience for you? Did you get knocked down? You know, like it's raising, you know, for your first time, you're raising 225,000. It's got to be, you know, you had to come to them with a deck, and you had to come to them with numbers and performas and all this information, and almost educate, I'm sure, probably a quarter of those people.
Right.
What was that experience like? Did you get no's? Did you get yeses? And what was that?
Yeah, I mean, I think the first meeting was a yes. So I think I had almost some, I was overly optimistic that this is gonna take me an afternoon. This is gonna be fine. I'll go knock it down, and ends up taking multiple weeks and a lot of no's along the way. But for the most part, I think it was it's a big roller coaster. Anytime you're looking at a transaction, you get excited about what it could end up looking like. You have to really love it to take that kind of abuse on a regular basis. But said it's really it ends up being enjoyable at the end of the day.
Okay. And then how long did you guys hold it for? 2 years?
Yeah, it was a little less than 2 years. So it was a pretty quick turnaround. So we had a great return on investment on the timeline basis. So an internal rate of return or an IRR was great on that one. And even the equity multiple wasn't bad either. You know, what you take as an investment and what you get as a return was still pretty solid as well. But no, I said it was a fun little deal.
So this is our 2-minute wrap up here. It basically, for $25,000, you made $500,000, and after 2 years, and out of that purchase, just to run it back, the purchase was $750,000. You put down $25,000. You raised $225,000. You bought it for $750 total, including your renovations. Then you held it for 2 years and sold it for $1.2 million. And you paid back all your investors, and you gave them returns on their money every, what is that, month or quarter?
Yeah, we actually didn't do any distributions until we actually sold the property. So we got lucky there, but I basically accrued what's called the preferred return during that period of time. So I had to pay them back a minimum of a 7% return on their money. Like that's kind of that bond example I was making earlier. And then we get to split the profits in the future. So I got to keep 40% of the profits, and they got to keep 60% of the profits.
Okay, look at you balling. Well, there's a question here from Haley that I just want to address before we wrap up. What was a key invite way to convince investors?
I said, I think that it's an asset-based thing, but at the end of the day, as long as you're being true and authentic to yourself, and also to your story and to what the plan of attack is going to end up being, that's really the main goal. I think most people realize that they can sense the authenticity when you're having a conversation with them. I think if you're trying to be too slick or trying to have too much of a sales pitch, that a lot of times it kind of falls on deaf ears. So for me, I am who I am, and either you're going to love that or you're going to hate it. And I think we have these conversations on a regular basis where if you end up figuring out, who you are and how you're going to sell yourself, that's important. Like for instance, it's like I have a sleeve of tattoos, and most people in the finance business don't have that, right? But at the same time, I'm not going to hide away and shy that away from that. So most investors, if they don't like me, they don't like me. It's totally fine. Hopefully we'll find somebody else that wants to do the deal. But at the end of the day, we find people that, we see eye to eye with. And so that kind of convincing that person is more about creating a relationship and creating trust than it is anything more than trying to sell them on a transaction.
That last sentence right there was everything. Just being you without trying to sell them and just being straightforward. I don't know if I have the 2 seconds to hit these two other questions.
Yes.
Yeah. Okay, cool. So from Chris, we got, are you seeing investment firms putting new construction on hold until SB9 comes into effect?
I'm not personally. So SB9, SB10 are interesting angles to look at the business. I have not seen as many opportunities in my sphere to really play in that space yet. I think as it becomes more commonplace within different cities, I think it'll be interesting to see how much that becomes more of an interesting angle for people to go ahead and take down. think because what I do is I just do mainly renovations of buildings. I don't really knock anything down and build new units. That's not something that's my kind of core bailiwick. Something that maybe we'll get into in the future, but I have not seen it personally.
Okay. And then I think the last one that's here is, which I think is a good one. Where did you find the investors that you pitched to for your first deal?
Oh, I mean, I thought this is a PG conversation, right? So we'll have to see kind of how deep we get here. But no, it's through friends of friends and friends, right? So you have the one person that almost becomes like your anchor investor. And so you find the first person that makes that one investment for you, and then they end up introducing you to a couple people. And then that kind of continues to expand out. So a lot of times that's, maybe it's golf related, or through it's an organization that you're a part of, or sports, or family, or a church, or anything that you're a part, that you're kind of your sphere of influence, and then just expanding it out from there. But once you find the first anchor investor, you can almost use them as a reference for you, like you would have for getting a job. That's a lot of times how it ends up working out. And then that person, that builds into something else, and then hopefully you find the larger deal, and you can point to what your successes were, and hopefully knock down more and more of those along the way, and the dominoes will start to fall, as Michael said. Hopefully one day become a Titan. I mean, it's a long way away for all of us, but hey, we can all dream, right?
Well, I appreciate everything, and the time and the knowledge and the stories and the experience. So thank you, my brother.
Of course, I'd say it's always a pleasure.
Yeah, Danny, Michael, that was brilliant. Fast, short-moving session. Thank you for your time, Danny. Keep up the good work, and thank you for inspiring. And you nailed it, right? We need to be able to choose who to be in business with, and vice versa. So well done, Michael. You're a genius for bringing amazing people to our community. So thank you guys for that. Have a great day.
Thanks, guys. Appreciate it. Thank you.
Bye.
What I was gonna ask is,
Good stuff.
how do they do it legally? Is it like do they make like an LLC?
Yeah, I didn't want to go to the depth. Yeah, I didn't want to go to the depth of how you build the whole syndications. We're going to do a separate class about that for sure. But yeah, I mean, usually when you have a member, the LLC, the syndication itself is an LLC. You have an agreement between the syndicator, the LLC, to the members. You see, look at the screen right now. You can have a member as you, as a just as Sandra. It can be Nathan Investments LLC. It can be S Corp. It can be a trust. It can be in any shape and form. Really, it depends how you want to hold title to that figure of speech, etc. Right? Yeah.
And you can make sure that works.
So good stuff. Once again, everything you see right now experiencing, we always do follow-up sessions as well. So we're gonna dive in more in depth to those things in the near future. So I'm gonna go to the next portion of the last one of my presentation for today. It's about cryptocurrency and the relationship with real estate today and in the future. If you don't know what crypto is, right? And how blockchain technology works, so you're one step behind. Okay, it's nothing new. It's been around for a very, very long time. This is right now one of the bigger aspects of existing and future technologies. Nothing that you're going to see over here is going to be any kind of piece of advice of what you should do and etc. But you need to educate yourself about what it is. So I had a speaker schedule, and they weren't able to put it off, unfortunately, and that's fine. So I did pick to my opinion, one of the best kind of 7 minutes 101 about what is blockchain, and then I'm gonna just show a few more things about that in the relationship between that and real estate, and we can have a bit of a conversation. So 7 minutes or so, buckle up and let's understand what blockchain is, okay? Listen, because it's very simple, yet you need to understand what it is. There we go. That's what it's supposed to work. So again.
Ever wonder if there's an easier way to complete transactions without having to deal with online wallets, banks, and third-party applications? Well, it's possible thanks to blockchain. Here's everything you need to know about blockchain. Imagine 4 friends, Jack, Ted, Sam, and Phil meet up for dinner. After they're done, Jack pays the bill, and all of them decide to split the expense amongst each other. Now, on the next day, when Phil sends his share to Jack via online money transfer, the transaction goes through without a hitch. Then Ted and Sam send their respective shares to Jack, but their transactions don't go through. The failed transaction cites some issues at the bank. That's when Jack comes to know about the many ways a bank transaction could fail. It could be due to technical issues at the bank. One of their accounts were hacked, daily transfer limits being exceeded, and sometimes additional charges, like transfer charges associated with transferring money. To solve these problems, the concept of cryptocurrency came into existence. Cryptocurrencies are a form of digital or virtual currency that run on a technology known as blockchain. Thanks to blockchain, cryptocurrencies are immune to counterfeiting, don't require a central authority, and are protected by strong and complex encryption algorithms. And in a market of more than thousands of cryptocurrencies like Litecoin, Ethereum, Zcash, and so on, one reigns supreme: Bitcoin. Now, let's go back to our previous example and have Phil, Ted, and Sam send Jack 2 Bitcoins each as their contribution to the previous night's dinner. Let's assume Phil, Ted, and Sam have 3 Bitcoins in reserve, while Jack has 5. First, Phil sends 2 Bitcoins to Jack. A record is created in the form of a block. The transaction details between them is permanently inscribed in this block. This record also holds the number of Bitcoins each of the friends own. So after Phil's transaction, Jack has 7 Bitcoins, while Phil has 1. Following this, Sam and Ted send 2 Bitcoins to Jack. A new block is created for each of these transactions. These blocks hold the transaction details as well as how many Bitcoins Sam, Ted, and Jack have in reserve. These blocks are linked to each other, as each of them takes reference from the previous one for the number of Bitcoins each friend owns. This chain of records, or blocks, is called a ledger, and this ledger is shared among all the friends, which acts as a public distributed ledger. This forms the basis of blockchain. So what happens when Phil has only 1 Bitcoin left and he tries to send 2 more Bitcoins to Jack? The transaction will not go through. This is because all his friends have copies of the ledger, and it's clear that Phil has only 1 Bitcoin left. His friends will flag this transaction as invalid. A hacker will not be able to alter the data in the blockchain because each user has a copy of the ledger. The data within the blocks are encrypted by complex algorithms. All of this is made possible with the help of blockchain technology. Blockchain can be described as a collection of records linked with each other, strongly resistant to alteration, and protected using cryptography. Now, let's have a closer look at the Bitcoin transaction between Jack and Phil and find out how it works. Every user in the Bitcoin network has 2 keys, a public key and a private key. The public key is an address that everyone in the network knows of, like an email address of a user. The private key is a unique address that only the user has knowledge of, something like a password. First, Phil passes the number of Bitcoins he wants to send to Jack, along with his and Jack's unique wallet address through a hashing algorithm. All of this is part of the transaction details. These details are encrypted using encryption algorithms and using Phil's unique private key. This is done to digitally sign the transaction and to indicate that the transactions came from Phil. This output is now transmitted across the world using Jack's public key. With this, the message or transaction can be decrypted only by Jack's private key, which only Jack has knowledge of. Different cryptocurrencies use different hashing algorithms. While Bitcoin uses the SHA-256 algorithm, Ethereum, which is also a famous cryptocurrency, uses one known as Ethash. This transaction and several other similar ones are taking place all around the world. These transactions are validated and then added block by block. The people who validate these blocks are called miners. For a block to be validated and added to a blockchain, miners need to solve a complex mathematical problem. The miner who solves this first adds the block to the blockchain and is rewarded with 12.5 Bitcoins. The process of solving the complex mathematical problem is called proof of work, and the process of adding a block to the blockchain is called mining. With this, Phil and Jack's wallets are updated. just like every person in the network who has completed a transaction. Now that you know about blockchain and its important concepts, time for a small quiz. What is the concept of blockchain that ensures data cannot be altered by any?
Okay, we're not doing any quiz over here, okay? Sandra, it's all good. Take it easy. Take it easy. First of all, did it give you a little bit of insight about what blockchain is? Okay, and then there's another part over there.
Ever wonder if there's any?
There's another part over there. Public key and private key. Public key is your identity, whatever, right? Private key is pull up a bill right now if you have in your pocket, a dollar bill, whatever. You look that there's a serial number on it. Usually it's a combination of letters and numbers. It's exactly the same thing. The same thing, right? And you want in the circulation, unless it's like a fake bill, right? Like a fraud. You can have the same bill with the same serial number, right? But they can still have, you know, those kind of bills circulating. With the blockchain, you cannot fake another serial number, which doesn't. It can happen. So it's one of the advantages to have crypto in that sense.
I didn't understand the end part though.
Say again?
I didn't understand the end part.
The end part?
Yeah.
What do you mean? Like how it's been recorded or what?
Well, no, they're recording it and then like the part of them getting a coin back.
Don't go too deep into that. The miners, think about them as the bank employees, right? Those are the people that are recording the data. Yeah, okay, in the whole blockchain technology. It's basically people that just buy the equipment. Those are really exactly. Okay, those are people that just buy, invest in that hardware. Those are very expensive.
Keep up with your money if you're going to need it, but now it makes sense.
Yeah, okay. So
We're still getting 12 bitcoins. Not anymore. That's a lot.
I don't want to go there. It's actually decreasing every year and everything. There's only limited number of available coins anyway. Like there's a limited amount of gold in the world, etc., etc. But I don't want to go too deep into that. I just want you to understand the concept, right? Of the blockchain technology. We spoke about that because you actually saw the what blockchain is, right? So the link between that and real estate is, in general, right? The wallet, right? The smart wallet is pretty much what you use instead of actual wallet with the bills. Then you have your wallet, right? If you ever, whoever has one, if you're gonna ever, have that capacity, make sure to always keep in a secure place the code words of that wallet, because once you lose it, you cannot recover it. Nobody has the copy besides you, right? It's that secure. So if you lose those code words, you lost the wallet forever. It doesn't matter how much crypto you had in it or coins and whatever it is. But you see the relationship now in the future is with smart contracts, transaction, etc., because it's so highly secured that it has the potential to be an addition funnel or system to transact not just real estate, any possible things in the future. And once again, it's already happening today. That's why I want to bring it to your attention for you to get to understand what it is. Recent data, right? First US deed, and that's a couple of years back. First US deed recorded with Ethereum using only blockchain technology, right? So you actually can have a deed to a property, right? Using blockchain. It's recorded somewhere, so there's a proof of, once again, of ownership. Currencies are being created specifically for real estate transactions. If you're going to go online and Google search Bitcoin, crypto money or types of crypto, whatever coins, you're going to have dozens, right? Some of them have value, some of them don't really have any kind of value other than just the meme, the name, the concept of what it is, right? Like Doge or how do you call the TV show right now? You know, with the masks, the Korean show, Squid Games, you know, currency doesn't have any value to do something with it, but it's worth a lot of money, right? So those are like just investments, etc. And I'm not giving any advice about what you should do or shouldn't do, but what I'm telling you is do investigation to understand what it is in a broad aspect, right? I'm gonna get your questions in a few minutes. Nationwide in California, the last few years, a few transactions were made using Bitcoins, Bitcoin to Bitcoin, Bitcoin to US dollar, right? So
apartment buildings for rent, saying use Bitcoin to rent.
yeah, so one of the biggest entrepreneurs in California, right, is Rick Caruso. Caruso, that's the development that they own the Americana, the Commons, the Promenade, and more and more and more. And they, the beginning of this year, I think as of officially April or May of this year, they open up their tenants to be able to pay by using Bitcoin. I'm not sure if other coins as well, but that was one of them, right? Because they kind of foresee the future of that and the value, right? Cryptocurrency is going nowhere. The only issue with that, it's very volatile, it's very risky. Back in 2000, like let's say just recently 15, and then this year again, the value dropped by 50%, right? I don't know about 15, the number, but this year it was in the high 60s, dropped to 29,000, by the way, okay, not $60, $60,000 one Bitcoin, right? Back in 2007, one Bitcoin was about $700, $700, so it's 100 times more, right? Challenges and risks, as I mentioned. Okay, so a few things. Number one is, once again, as I mentioned, it's volatile, right? It's fluctuating, it changes. It doesn't really tie to any factory or manufacturing or anything whatsoever. It's just 100% just speculation of value. At the same time, there is, if you understand how it works, like you know, any other markets, right? There's actual cash value to it, right? Like with stocks. So there's real money that has that value. It's not like it's just a fake concept. There's real dollar amount, and some of the coins, by the way, they're backed by gold, for example, right? Sitting in London, there's a whole coin just reflects the gold, for example. So it's backed by real money. The risk is all those years was about the future of the crypto coin. Now it's already changed, but it's changing even more, right? The issue in California specifically is if someone want to transact with crypto, is a lender is gonna have a big issue with that, right? Because of the California, you know, good funds law, etc. It's gonna be some cash value or dollar value, and there's a lot of like disclosures of where the money come from, etc. It's easier if you're just using the wallet to convert a Bitcoin to US dollar than to the dollar and buy the house, right? But Bitcoin to Bitcoin is still a bit more challenging, right? So that's the issue with the underwriter, etc. Title company also see it as an issue because they have to secure the transaction based on different factors. And once again, it's just the California rules. I personally think that all those things are going to change to the benefit of crypto, for sure.
For example, my recent transaction that I closed with buyer, more than half of his proof of funds were his crypto, and the other agent was like knowledgeable about crypto, so he's like, oh, I convinced the seller that he has the funds and don't worry. Yeah. Well, he probably advised, he didn't convince, because we don't convince anybody in our business, right? That's his deal, but not you, them. But I just want to use the right language because we understand and learn from this, right? So, yes.
So it looks like
Hold on, yes.
it looks like you're buying property with the other currency, like yen or like euro or something else that in California it doesn't feel it's the real money. That's you bring money from you also, like,
Yeah, but at the same time, in the US, you can only transact with US dollar.
exactly, that's why they.
That's
Exactly.
correct, that's my point, right? So that's open like a whole brand new opportunity to investments and to people that have those coins, right? So just kind of, more in depth of like, possible uses turn now in the future, more like about how that can be used in real estate, right? Pretty much any type of aspect, right? And just good to know that already the smart contracts that backed by a couple of crypto currencies, they're already up and running. It's not like it's going to happen. It's already happening, right? The only challenge is once again the legality, etc., the laws, state level, maybe federal level. I don't really know about that. And the last part, I'm going to open up a question is to whatever I know, is the escrow solution. So our escrow company, Pacific Coastline, is right in the process to open up to be able to transact using crypto. Yeah, Bitcoin mostly, but not just. As long as you have the wallet, and you can do that. That's possible. So the process right now, hopefully by the first quarter of 2022, Pacific Coastline Escrow will be also a crypto supportive company, right? We actually have a few deals waiting, so we can transact via crypto just for that. So it's kind of cool. Okay, let me look at the chat first, because you guys have been patient. Thank you. 1 second, just going up. So the notes, Luis, as a set of retail condos in New York City is selling for 21 million exclusively in Bitcoin, signaling a growing trend of luxury real estate purchases being made using cryptocurrency like Forbes. Yeah, awesome, Luis. Thanks for sharing. I told you it's happening. Okay, it's nothing new. Joanne, there are some seller here in Los Angeles are accepting cryptocurrency. Thank you. It's in the MLS. It's military technology that was used to verify transactions. Awesome. Chris, I'm a crypto believer. I like that. I'm a crypto believer, right? I'm Jewish, I'm Christian, I'm a crypto believer. But I'm not sure what the advantages is here. Real estate enjoys a great deal of value due to property rights enforced by governments. The appeal of blockchain currencies is that it's bypassed governments entirely, correct? It is a good, interesting investment, but does it offer anything special for real estate in California? Chris, you nailed it, my friend. Good point. I don't have any answer. What I can tell you, based on my opinion, is that look, crypto has value, right? If you convert crypto to dollar, let's say you have you want to buy a house in the valley and it's worth $700,000, and you take your 10 Bitcoins and you convert them to cash. So you have, let's say, about $700,000, and you buy a house. So you can use your Bitcoins to purchase something, in this specific case, real estate. About the whole why cryptocurrency came about and everything, the whole philosophy behind it, I don't want to go there. It is definitely to challenge the the way that money works today. The central concept of the money, who controls that, inflation, etc., etc. But it's a whole different conversation. But good point, Chris. Thank you for pointing this out. And Joan is also a big supporter of you. Cool. Any questions? Any questions?
So right now, we have buyers who are using crypto to buy homes, but we don't have sellers that are accepting crypto.
So the question was, she said, now we have buyers, or just a remark. We have buyers that are looking to buy with crypto. They have the crypto, right? But they don't have sellers that they can find. So most likely what you should do, and there may be a lot of creative ideas out there, go on Facebook, go on Instagram, go on different places. Be careful with Instagram though, where you have different forums of people that holding crypto, whatever, and try to find people of interest that have properties and open to sell for a Bitcoin or whatever it is, right? So find the hubs, find a group of people that transact and looking for that consumer. Another from Louis Staples Center to become Crypto.com arena in reported 700 million naming rights deal. Yeah, it's the real deal. It's already there, right? So my message to you guys, and thank you for the interaction, is we see anything else? Yeah, nothing else. My message is that every time that you're resistant, every time that we are resistant to something new, it's a trigger that an obligation that we need to learn what it is. It can be something, it can be someone, it can be somewhere, it can be anything whatsoever. And especially in our industry, and I'm a big believer in diversity, right? It's our obligation to always challenge what is new and what is different. Okay, it's our obligation, especially in that kind of a big metropolitan, insane melting pot. It's going to make you a better entrepreneur. It's going to make you a better person. And go back to 2007. Hey, Shukru, there's this thing still called Bitcoin. You want to buy it? I have 10 of them. I have 100 of them. You want to buy it for $70,000? What, are you crazy? She would worth 7 million today. Okay. So to my point is, never make assumption. Always learn and research, and make yourself also a reliable source of that information, a resourceful person, so at least you know what the conversation is, because you can never know. A good job when you're having buyers in that arena. You never know who's on the other side. Make sense?
Yeah.
Yes,
All right.
thank you.
So guys, thank you so much for your time.
Thank you.
I appreciate it. I'm going to share all the